So, what's up, guys? We must be live. Let me check really quick my screen whether we are live on YouTube. Yep, we are live. Hope you have a great day. You slept well. It's Sunday. It's probably the time of the week to calm down, take some time off, have some fun, maybe read some articles when it comes to the stock market or some crypto news. I'm adjusting my screen and let's go ahead and jump in where we left the other time. I think I had opened an article. Let me see on Barron's. Did we, where? Oh, here is it. That's an 11-minute article, but I thought it might have been. It might have been. I thought it was a good idea to read it with you guys. Why it's time to invest in commodities and how to do it. So a lot of big YouTubers are not big fans of commodities, but I think there is value in reading the opposite side too sometimes. Let's see what Barons think. Barons is a known newsletter that's a known newsletter when it comes to the stock market and news. Commodities are rarely exciting, and the price of copper, corn, or even oil doesn't steer investors the way a tweet from Elon Musk does. Yet commodities sit at the crossroads of today's biggest investment themes: rising inflation and changing China, and the transition away from fossil fuels amid increased attention to climate change. I mean, rising inflation. We have seen the inflation rising a lot, and at that point, many people are waiting for an inflection point where we start going down. I wonder how that will impact the commodity market, gold and everything in between. The Bloomberg Commodity Index rose 27% in 2021, almost like the S&P, almost in line with the S&P. Those three big trends are still going strong, so more gains could be ahead of for some commodities like oil and agricultural commodities such as corn. But the price run-ups mean that investors need to pick their spots carefully. The factors affecting commodity prices and determining which ones investors should focus on often overlap and have different short-term and long-term implications. Actively managed funds are able to spot and take advantage of changing trends for three good, yeah, whatever. Okay, let's move on. Inflation has been one of the biggest drivers of the recent economic and market trends. The most recent consumer price index or CPI, let me check if the live is working. Yeah, the live is working, nice. The market trends. The most recent economic price index, the CPI, inflation report showed that prices rose across the board in November by quite a lot, 6.8%. And in December, the Federal Reserve acknowledged that inflation was indeed a sustainable trend, not transitory, and that it's moving ahead with plans to raise interest rates to battle inflationary pressures. We are supposed to have like 3 or 4 raise interest hikes in 2022, but many people debate on that whether the Fed will be able to do that. I guess we'll be here and wait and see. And yeah, they are trying to battle inflationary pressures. Even as the Omicron variant spreads, the world is snapping back from pandemic lockdowns. There is pent-up demand for household items, corporate endeavors, municipal projects, and of course, let's see, for the commodities that are needed, all kinds of production. Meanwhile, many of those commodities are in short supply. That's a big factor here. Many of these commodities are in short supply. Add in supply chain problems in getting these commodities into production and the produced goods to the end user. And it's no wonder that prices are rising. So this is so we see a cycle here. They are already in short supply. They have supply chain problems. So everything goes down to the end user, where the price rise. Then there is no wonder that the prices are rising. Investors wanting to hedge against inflation, which makes stocks more volatile, have long turned to commodities. It's a broad, if you can beat them, join them strategy. If inflation is rising, the price of commodities are typically rising as well. So part of your portfolio will benefit even as some investment returns are muted. Energy futures have the best correlation with US inflation, but over the long term, agriculture, livestock, and industrial metals are all positive correlated since 2000. The Bloomberg Commodity Index's monthly year-over-year returns have had a 76% correlation with US consumer price index data. And today's inflation is driven by structural factors that are changing the economy, business, and how we live. Greenflation, what is that? First time I hear about that. Is an additional factor driving inflation and will benefit commodities needed for the green energy transition. Especially copper, which is used in all things digital, lithium used for batteries, aluminum, etc. I mean, commodities are kind of boring, man. I can't even stand to read this whole article. These efforts are the basis for plans to become carbon neutral or net zero that many companies and nations have made. These institutions are setting dates by which their operations will add to the release of carbon dioxide into the atmosphere. And any emissions they do produce will be offset by green projects that reduce carbon. These are costly, decades-long plans that will change the supply and demand profile of many commodities. While inflation is a broad argument for investing in commodities, the influence of China, sorry, the biggest consumer of commodities, the dynamics around specific trends, and the already big run-up in the prices of some commodities mean that investors will benefit from a more targeted approach. So what are they saying here? The health of the Chinese economy is one of the biggest determinants of commodity pricing, and the near-term outlook isn't great. The world's second largest economy was a primary driver for the last commodity super cycle. As the country shifts urbanization, aggressive stimulus after the financial crisis, and rapid economic growth created voracious demand. The backdrop is very different today. China's economic growth has slowed to 5%, and its policymakers are focused on creating a balanced, resilient economy than unbridled growth. One example of this shift is priorities in Beijing's crackdown on China's debt loan property sector. I mean, we heard the other day Cathy Wood talking about how on China they will destroy like 39 buildings that didn't have certain permits that they need. It's kind of funny seeing that, but also scary from the other side of the world. By implementing fiscal regulations that purge large property developers like China Evergrande to the brink of bankruptcy, and left investors concerned that property problems would drag the economy down even further. Instead of country industrializing, we have a country that accounts for 55% of metals demand slowing down. Okay, sealed against high prices. Commodities tend to rise with inflation, making them a good hedge. Stocks tend to fall when inflation heats up. So what is that? That's the S&P versus the commodities, the Bloomberg Commodity Index from all the way to 2000, October 31 of 2000 to now. Look at that. S&P is up 520% and the commodities are up only 44% if you just held your positions there. And that's insane actually, seeing that. That tells you a story. It's probably best to stick with stocks over the long run that have cash flows and are almost limitless. They are almost limitless. Yet over the long term, China will remain a big driver of demand. Its property market accounts for 30% of the global demand for copper, which means further gains in copper prices are likely in the near future. But metals, especially copper, have a bright future as China embraces green technology. Beijing has announced plans to be carbon neutral by 2060, a transition that will be years in the making and bodes well for industrial metals used in electric vehicles. Just a fifth of the cars sold in China today are some type of electric, think battery, plug-in or hybrid, compared with 40% in Europe. Demand for EVs probably won't rival demand for traditional cars until after 2026, says Caneva. Until China's energy transition gets further along and its property sector stabilizes, industrial metals are not the best near-term option for combating inflation or boosting returns. At this point, I'm fully bored from this article. Energy, green and black. What is black? Okay, in the US, alternative energy is in short supply. Energy is a big trend, I mean, even when it comes to stocks. And energy storage as well. The energy transition is another big factor in commodity prices and one that's creating lots of opportunity. As anyone who has raised a teenager knows, transitions can be difficult and full of conflict. There are three big forces at work in energy prices: fuel shortages in the short term, the inexorable march toward renewable energy in the longer term, and the increasing emphasis from US companies and their investors on environmental, social, and governance issues known as ESG. That plays a huge role now when it comes to stocks. In the funding that they get or the investments that they get from funds, etc. Or even companies like BlackRock. In the US, alternative energy is in short supply, creating a backdrop for higher prices. Okay, expect these shortages to continue as companies and countries around the world invest heavily in renewable energy decarbonization and efforts to make buildings more energy efficient. Investors have also increased their scrutiny of business practices, making it harder to mine for commodities that are already in short supply. Okay, we're almost done. Let's skip agriculture. Then the last paragraph here, the technical case. One of the factors that most excites investors is the technical future that's a byproduct of the broader industry backdrop. Most commodities are in backwardation, which means prices for a commodity tomorrow are lower than what it costs today. Backwardation is typically short-lived, but some investors expect it to persist. particularly in the energy market, where it is a manifestation of the energy transition, shortages, and underinvestment. It's very different than in the super cycle 10 or 20 years ago when the price of oil was 85, but no one knew where the next barrel would come from. So there was an expectation that for prices to rise. Okay, today the US shale boom means the US can increase energy supply easily, and the trend move towards renewables means that energy prices are headed lower in the long run. Johnson and other managers like backwardation because prices don't need to rise to make money. Managers can earn a return just by rolling a contract over to the next one to realize an attractive roll yield. Okay, if an investor buys the front future contracts in oil at 80, but 1 year is trading at just 74, they can just buy it for $6 less. So even if the price remains the same, they have backed at 8% return. The average roll yield for the Bloomberg Commodity Index is about 3.3%. Okay, I mean, nothing that interesting. I didn't learn that much from this article, so it was kind of boring. Anyway, let's see what do we have here. Why this page isn't working. Let's reload it maybe. Commodities are driving inflation, that's what we read now. Robinhood is making changes. Keep an eye on its stock. Man, I have a position on Robinhood. I'm waiting for this. I'm waiting for this, man. It's for so long. We delve into the world of meme stock trading. Meme stock mania raised big questions for regulators. Robinhood stock shot up for a few days after the company's initial public offering, but has steadily dropped since then. I mean, it's down to $16, man. It's down 50% from the IPO price, and like how I think it even reached $80 at one point. That's like 1/4 the price. That's less than 1/4. Let's say 1/5 the price. It's down an insane amount. Let's read that article about Robinhood. It will be probably interesting. Oh, just got a notification from Binance. Look at that. Big money flowed into crypto in 2021. A record 9.3 billion of institutional money entered crypto investments according to Coindesk. That for more. That's a nice headline. Anyway, let's read this article. I'm waiting so much for some good news when it comes to Robinhood and waiting for this stock to pick back up. Anyway, Robinhood market stock is in the doldrums, down more than 50% from its IPO, as I said. The company is making moves to reverse that decline, but unlike in the past, now it isn't relying on meme stocks or Dogecoin. Instead, its latest transformation could make it look like a more stodgy and perhaps more profitable. When Robinhood ticker HOOD went public, it traded at a widely inflated valuation based on earnings that are still years away from fruition. That's why Barron warned investors to stay away from the initial public offering. Robinhood stock is now trading at about 7 times its expected 2021 sales, down from about 20 at its debut. The company still doesn't have a clear path to profitability, but its latest moves point to one direction. What it does have is 22 million customers. That's nice. A remarkable feat for such a young firm. The company announced on Thursday that it would appoint Steve Quirk, the former executive vice president of trading and education at TD Ameritrade, as its chief brokerage officer, a new position. He will oversee the company's broker-dealers, Robinhood Financial and Robinhood Securities. In his announcement, Robinhood emphasized Quirk's more than 35 years of brokerage experience. That's nice. But 35 years sounds like a lot, in my opinion. Let's move on. Going down, Robinhood stock shot up for a few days after the company's initial public offering has steadily dropped since then. Robinhood's top management team has more tech-weighted, with several top executives coming from places. Look at that. Robinhood's top management has been more tech-weighted, with several top executives coming from places like Alphabet, Google, and Amazon. That's nice. I didn't know that. That may have helped Robinhood impress users with its easy-to-use interface and tech features. Let me change the title of this live, by the way. Robinhood stock news, Barron's stock market articles. Let's leave it at that. That's nice. Let's go back to this article. But the company couldn't convince them to park much money, what it says here. That may have helped Robinhood impress users with its easy-to-use interface and tech features. But the company couldn't convince them to park much money in the brokerage firm, they say that because the average amount of money that they have on their accounts is kind of low when compared to other brokerage accounts. The biggest sign that Robinhood is looking to broaden its model is a new program that will steer new investors into more diversified portfolios if they ask for help. For years, Robinhood has introduced new customers to its platform with a free stock and visual cues, like scratch-off tickets. It has adamantly adamantly, it denied that doing so made its platform more like a lottery or gambling app. Its latest innovation, announced on Tuesday, will instead direct new investors. Announced on Tuesday, okay, will instead direct new investors to a much more plain vanilla strategy, buying a basket of exchange traded funds. That's an article from last day, so it's a new one. Let's move on. The recommended ETFs will give customers exposure to a diverse set of domestic and international equities, as well as exposure to the US bond market. The company said in a blog post, if the ETF package attracts investors, it could be a significant step toward making Robinhood's business model. Remaking Robinhood's business model. Okay, more than 3/4 of Robinhood's revenue comes from transactions, a percentage that it will have to reduce in order for the company to flatten its boom and bust financial trajectory and to produce steady earnings. And one thing that many people don't like when it comes to Robinhood is the fact that they don't have steady earnings. Their earnings go up one year, down a lot of the other, and long-term investors definitely don't like that. That's why the stock is treated more as a trade for a lot of investors. More diversified investing and fewer lottery tickets could be a first step to getting there. I mean, that would take a lot of time if they want to change the perceived look that this company has. Let's go check the Robinhood stock really quick. Just on Yahoo Finance to see some basic stuff together maybe. Let's close this article. Let's go back to some news. Let's open CNBC too. Might have some videos there. They usually have some. Inflation, rising rates, and the Federal Reserve could whip stocks around in the week ahead. Okay. Cyprus reportedly discovers a COVID variant that combines Omicron and Delta. I mean, that's kind of funny at this point. That's a joke at this point. Biden administration says no firm commitment will be made during talks with Russia. Okay. Elon Musk, we read that story the other day. Nothing particularly interesting on CNBC. We see the markets that are down. You see copper here. Okay, let's check oil, natural gas going up. Nothing that interesting. Let's check Robinhood on here. Look at that. From a 30 billion market cap, Robinhood right now is at 13. Man, that's insane. That's insane. And they're missing everything. How can the stock not go to zero, man? It's on a huge downtrend. It's on a huge downtrend that it definitely needs to break out of soon, or it will be scary to see what happens here. Let's take the let's see statistics. Is that what I want to check? If it loads. Market cap. That's not updated. So let's see. 52-week change, down 50%. Everything looks negative. Revenue 1.77 billion. Quarterly revenue growth 35% year over year. Gross profit $709 million. Okay. Let's see, total cost 10 billion. I mean, that's one thing that who is it? Meet Kevin has mentioned a lot of times that they have a lot of cash on the side. When you're buying this company, it's almost like you're buying a ton of cash too at the same time. That can be a good thing and a bad thing at the same time. 10.6 billion is a lot for a company that has a market cap of 13 billion. That means that they only value the company at around, like, let's see, they're around 3 billion right now if they didn't have the money on the side. That's insanely low. Total debt 3.28 billion. That's not that much. That's 1/3 of the total cash that they have lying around. But yeah. Anyway, let's move on. If we find anything else particularly interesting, Fed rate hikes. It's 9 trillion in assets is what really matters. The Fed hockey's turn. Yeah, I mean that's true. If they start selling what they bought, that would be kind of bad. Look at that guy, the swag on Jerome Powell. He says he has a mask on that says, what does it even say here? Board of Governors. What does it even say here? The Federal Reserve, the Federal Reserve System, Board of Governors, Fed. Man, he even has a mask, a Fed mask. If there's one takeaway from another model jobs report, it's this: the Federal Reserve is behind the curve and falling fast. Investors should brace for more aggressive tightening and even welcome it. Okay. The scary thing is that we see turbulence in the stock market, even with the Fed mentioning about how they're gonna approach the things. Imagine when they actually do it. Imagine when they actually raise interest rates. That's scary a lot, man. It almost makes me want to sell everything sometimes, just to get off the markets completely. But I remind myself of what Peter Lynch says to invest despite the market news anytime. Let's just and invest in companies that you believe in long term, that have cash flows that are increasing in their earnings, etc. If their earnings are increasing, the stock price will probably increase after a while, and that's a mindset that I have when I'm investing. As was the case in the prior month, the headline non-farm payrolls figure for December believes a report that reflects a stubborn, ongoing labor shortage that is fueling inflation. Millions of workers continue to defy expectations for a mass return to work, with labor force participation stuck well below pre-pandemic levels, and the 0.6 rise in hourly pay from November underrepresents how quickly employers are reducing pay to attract help. Ed Yardeni, president of Yardeni Research, says he earns income proxy for wages and salaries in the private sector jumped from 0.8% from a month earlier and 9.9% from a year earlier. Wages outpacing inflation looks good for purchasing power, but the dynamic is also a red flag for the dreaded wage price spiral that characterized the 1970s. What's more, an unemployment rate of 3.9% is now below what the Fed has said in the natural rate of unemployment, or the lowest rate of joblessness, where inflation is stable, when the unemployment rate fell below 4% during the last expansion. The Fed was already more than 2 years into a rate hike cycle, and nearly a year into a liquidity draining program, says Michael Darda, chief economist and market strategist at NKM Partners. The Fed is behind the curve relative to the last cycle based on virtually all of the relevant employment metrics, says Darda. His model for the neutral interest rate, which represents a just right economy, continues to push higher. If the policy rate near zero is a standstill, while the neutral rate rises, the Fed becomes more accommodative by default, he says. Ballooning balance sheet. How the Fed reduces its 9 trillion in security holdings may be more consequential than raising rates. Look at that, man. 9 trillion in security holdings. Oh my god. Look at that, since 20. I mean, it already had an upper sloping trend, but it completely exploded from 4 trillion all the way to 3 trillion in a matter of months in 2020. It gets worse. Darda says a rising neutral rate means the so-called velocity of money is likely about to rise. With a faster rate of money turnover triggering a rise in demand, the economy can't handle and thus exacerbating already hot inflation. So where do we go from here? The growing consensus for a March interest rates liftoff with 2 subsequent rate increases this year is the easy part. It's also somewhat meaningless until the Fed does the harder job of shrinking the 9 trillion balance sheet. Talk of balance sheet shrinkage is enough to put many investors to sleep. When the Fed embarked upon balance sheet normalization in 2017, then Fed Chairman Janet Yellen suggested it run quietly in the background and be as exciting as watching paint dry. But that seems wishful thinking this time around. Back then, the balance sheet was half today's size, and city economist Veronica Clark puts it, there is a growing sense that the Fed officials realized the asset purchase program in response to the pandemic has been too big and lasted too long. Scary things, man. In the recently released minutes from their December meeting, central bankers signaled they may start winding down the balance sheet sooner and more aggressively than markets have expected. Clark pushed up her expectation for normalization to begin in July, by which it means the Fed will start with a 25 billion monthly decline in reinvestment as securities mature and bump up to 75 billion monthly decline in reinvestment. I mean, if we look at this chart, right? Look at this chart. It keeps the balance sheet is keep ballooning, is keep inflating. Look at that. For how long can they reduce it? They have failed to do that every time since 2000. Look at that. The balance sheet then was $700,000 million, and right now it's trillions. And then on 2008 it jumped to 2.2 trillion. They failed to lower that. It only went to 1.8. Then it increased again slowly but surely with some turbulence here, but they have failed every time to increase it. Look at that. it just keeps on increasing. Well, there's so much printing, man. Look at that. 2.8, 2.9, 2.8, 4.3. They have completely failed to decrease it. And when they almost tried decreasing it, it then completely went back up. Look at that. 4 trillion. 4 trillion from, that's 3 trillion from 4.3 to 7, man. And now in total, it's up 4.7 from the depths of 2020. Like 5 trillion up for $5 trillion dollars up from the depths of 2020 before the March crash. How they won't be able to reduce that. They won't be able to reduce that. You shared it here first. Even if they reduce it, it will, something like this will happen. First, it has to stabilize, then it has to reduce for, like, look at that. It was 4.5 and it went to 3.7. What's that's a decrease of, let's say, not 10%. That's a decrease of 20%. We might see a crash of 10% or 20% in the market. We have already seen stocks correcting a bit in anticipation of what they might do, or the interest rate hikes. But they decreased it 20% here. But they completely failed because they ballooned it then up 5 trillion. So what's the point if they decreased it 20%, but then they like 2x it again, and from 5 trillion it goes to, from 8 trillion in total, it goes to let's say 16 trillion then later. That might forbid okay, let's move on. What's the point? So where do we go from here? The growing consensus for a March interest rate lift off with two. Okay, I read that, I think. Let's move on. Recently, okay, here we are. Central bankers signaled they may start winding down the balance sheet sooner and more aggressively than markets have expected. Clark pushed up her expectation for normalization beginning July, by which it means the Fed will start with 25 billion monthly decline in reinvestment as securities mature, and up to a 75 billion monthly decline in reinvestment. Barry Knapp, by the way, they are still printing now as we're talking. Director of Research at Ironside's Microeconomics says December jobs data bolstered the argument for earlier and faster balance sheet contraction. Fed officials waiting for full employment have missed the boat, he says, calling current monetary policy reckless and maintaining that the Fed won't actually be tightening policy until its own holdings decline. So look at that. Fed officials waiting for full employment have missed the boat, he says, calling current monetary policy reckless, risky, and maintaining that the Fed won't actually be tightening policy until its own holdings decline. What does that even mean? They won't be tightening policy, tightening the printing. I mean, what do they mean here? Until its own holdings decline. They won't stop printing until they start selling their holdings. What? I don't get it. The idea. The Fed owns about a third of the Treasury and mortgage markets, and long-term rates won't really rise until the Fed's funds rate diminishes. Rate increases on their own would thus be ineffective if bond markets aren't speaking for themselves and adjusting accordingly. They have ostensibly started to tighten and things are actually getting looser, Knapp says, referring to still negative inflation adjusted real interest rates despite the Fed's hawkish pivots. They start the taper process and the market laughs at them, or so it seems. By the way, let me check something. I want to check if I can watch my own live and check the chat when I'm... Okay, nice, I can watch it. That's interesting. Oh, that's good, so I can check the chat. Okay, nice, I didn't know that. And can I actually have on the side stocks so I can see their prices at the same time? Yeah, I can. Look at that. Man, that's insane, that's nice. I can both check the chat and the prices on the side of on stocks, the stock prices. Okay, let's see. They start the taper process and the market laughs at them. Also, it seems because the bond market is so distorted by the impact of Fed asset purchases. But Knapp says the opposite. Let's see. In a conventional way, all of this sounds like a recipe for crashing stocks, but Knapp says the opposite is true, at least for those with a bit of patience. A bit of patience. And keen to the idea that monetary policy that is too accommodative impedes growth. Consider the housing market flooded by investors pushing aside will be first-time buyers. Okay. For this distinct period of time, Roughly the first half of this year, the removal of accommodative monetary policy will be tough for markets, but a net positive for the economy, says Knapp. He sees a 10 to 12% decline on top for major indexes on account of tightening, and suggests investors view it simply as a great buying opportunity. I mean, what we read the other day was kind of interesting. The fact that when we see a divergence of 3 to 4% between the interest rates and the, what was it? What was the other number? Come on now. And the 10-year treasury yields, then we see the S&P rising like 6% or something, 6 to 7%. That was an interesting take that we read on an article last day. Anyway, he sees a 10 to 12% decline on top for major indexes account of tightening, and suggests investors view it simply as a great buying opportunity. For a while, the talk is going to be about the Fed hiring into a slowing economy, especially as Omicron invariably begins to hit economic data. But it's worth seeing the forest for the trees. Tightening, in this case, the real kind, which includes balance reduction, may help remove counterproductive forces and help prevent the Fed from falling even further behind the curve on inflation that is only going to get worse in the coming months. Okay, anyway, I'm bored with Barron right now, so let's go to Coindesk, maybe read some news there, and we'll close the live stream in like, let's say 15 minutes. Oh, we have two viewers watching. Say hi, guys, say hi, why don't you comment? What's up? Let's go to Coindesk, maybe read some articles when it comes to crypto, in regards to crypto. Let's check the prices as well. So Bitcoin is sitting at 41.7k. By the way, definitely go watch the video that I made of a recap of the crypto market for the last couple of weeks and months. Definitely go watch it on my channel after we finish this live stream. 41.7k for Bitcoin right now, 3.1k for Ethereum. I mean, that's a good opportunity to buy Ethereum at around 3k. That's a good price for Ethereum. Cardano, I'm waiting for Cardano to drop to 105. 105. I would love to buy Cardano at 105, and I believe it can drop there. That's why I'm saying that. Look at that though. Solana is holding strong at 43 billion. That's insane for Solana. BNB has taken a big hit all the way from 100 billion market cap to 72. That's 20%, 28% down. That's like 30% down because I reached even more than 100 billion market cap. Anyway, let's go to Coindesk. Bitcoin falls toward 40k. Racks up longest losing streak since 2018. India's central bank creates fintech department as challenges posed by crypto. Okay, no one cares about India, or at least I think so. Industry body for India starts up 6 crypto rules. Okay, PayPal is exploring its own stablecoin as crypto business grows. Let's read these two articles. There is nothing that interesting today. That's a nice picture, by the way. Let's see. PayPal is exploring creating its own stablecoin as crypto businesses grow. Hidden code in the company's iPhone app shows that a potential PayPal coin will be backed by the US dollar. PayPal is looking into launching its own stablecoin as the company grows its crypto business, a company spokesman confirmed to Coindesk. Well, PayPal might actually be able to make happen what Facebook failed to do so with Libra, its coin. Sources told Coindesk in September that PayPal subsidiary Curve was actually working on developing a stablecoin. We are exploring a stablecoin if and when we seek to move forward. We will of course work closely with relevant regulators. That's nice. I seen the other day an interview that they're talking about building something on Ethereum too, if that's any interesting. Bloomberg first reported the news after evidence of PayPal exploration into building its own stablecoin was discovered in the company's iPhone app by developer Steve Mosher and shared with Bloomberg. Hidden code and images show work on what is called PayPal coin. The code shows that the coin will be backed by the US dollar. Okay, PayPal has been very active with its cryptocurrency efforts recently, increasing the amount of crypto its customers can purchase, as well as investing in educating its users in crypto networking to allow them to withdraw their crypto safely to third-party wallets. I think this is still not available on PayPal. You still can withdraw. Payment services giants see crypto as an opportunity, not threat. I think this is still not available on PayPal, and that's one reason why many people don't like that. Don't like investing in cryptos on PayPal, because you can withdraw your crypto. But they say that they're working on that. Robinhood is also working on that, so we're waiting for news from everyone. A PayPal spokesperson told Bloomberg that images and code inside of the PayPal app stemmed from a recent internal hackathon, an event in which engineers team up to really explore and build new products that they may never see public release with the company's blockchain, crypto and digital currencies division. Okay. nothing incredibly interesting. 7-day losing streak. 40k level is a huge support, man. 39.3. Bitcoin falls short 40k. Racks up longest losing streak since 2018. Cryptocurrency analysts had warned of the possibility of a steeper sell-off, and now traders are wondering when the market shakeout might end. Okay, let's see here. We're talking about the big decline that we had. As of press time, Bitcoin was changing hands around 40,800, down 2.3% over the past 24 hours. Okay, crypto market analysts had warned recently that Bitcoin might be prone to a steeper sell-off. Though there were some signs late last week that the market might be stabilizing. January tends to be a seasonally weak month for Bitcoin, but this year has been especially harsh, with the largest cryptocurrency down 11% so far in 2022. The market was roiled last week by the release of Federal Reserve minutes, signaling that officials at the US Central Bank were starting to discuss where to take more aggressive steps. Okay, I mean, it's kind of boring, nothing particularly interesting here. Macroeconomic uncertainty has led to relatively low conviction from market players. It's sad that the dollar is growing too now, and that's pushing prices of assets down a lot. How long can this happen for, though? I don't understand how the dollar can be on an uptrend right now, even for a small time, when it's being printed into oblivion from the Federal Reserve. As of Friday, the price was down 35% from the all-time high. Previous drawdowns have reached levels of nearly 80%, and it took the market months to recover. Some bulls are still betting that the market is on the cusp of a fresh bull run, but analysts for the investment research firm Fundstrat say the market looks to have little near-term price support until it drops to 39,570, roughly where the price bottomed in September 2021. That's the line in the sand, in my opinion. Anyway, that's all for this live stream for now. Let's keep it small. Let's keep it short, and I'll see you guys on the next one. Yeah.